Hi everyone, welcome to the channel. Today our focus is going to be on Snap-On, ticker SNA, known for professional grade tools used by mechanics, engineers, craftsmen throughout various industries. Now the stock has dropped about 10% after they recently released their fiscal year 2023 results, which I believe is an overreaction from the market. As the results overall were positive, though they did have one segment that was lagging. Now, in this video, we'll look at Snap-on's financials, perform a stock valuation, and at the end of the video, we'll look at my previous computer modeling predictions and provide an update for the next 52-week stock movement. But since this is a company I do own, we'll look at my purchases first. So let's jump right into it. Here are all my investments into Snap-on. You can see I started back in March of 2022 at just over $200 a share, and I've been buying ever since based on the stock price relative to my valuation at the time. And overall, with dividends, my total return is just over 15%. While if I bought into the S&P 500 on those same days, my return would have been slightly under 16%. So I am trailing the S&P 500 about half a percentage point. But I do want to point out that Snap-on recently released their fiscal year 2023 results the other week, and following that, the stock price did drop about 10%. And I do feel it's an overreaction by the market, and I think over the coming weeks, the stock price should recover, and we'll look into that a little bit more when we get into their financials. But scrolling down, you can see the rest of my investments, and down at the bottom, the total summary. So my total investment right now is just over almost $33,600, and the current valuation is $38,000. For the total gains and losses, we can see it is reporting 9.26% return. However, that's not taking into account the investment in the account at the top, probably because I just purchased some more shares today in that account, so it's probably still updating. But the overall return should be about 12% or so, and with dividends, brings it up to the 15.35% return we looked at in the beginning. And for reference, here's how my portfolio performed overall on a down day, February 13th. The market was down due to inflation coming in a little harder than expected, as I mentioned a few moments ago. And we can see right there, Snap-on down a little over 2%. And overall, the portfolio down almost 24,000. I'm going to jump to another slide, and I will show you the overall returns. And then the overall results for the portfolio, we can see Snap-on there at 13.5%. And when I'll point out PayPal, we can see that's down overall. It's one of my newer investments, and I do believe the stock's undervalued. I did do a couple videos on PayPal if you're interested. So I do feel it's undervalued, and hopefully in the coming months, market will realize that and the stock price will recover. And another one to point out is Palantir. It's actually one of my bigger investments, and I've owned that for probably almost 4 years now, I believe. And I've done some videos. I'm going to do an updated video based on their recent results, and the market did receive those results favorable. And the stock was trading, I think, around $17, and now it's up to $24, $25 a share. Looking at their financials, we're going to focus on dividends first. And we can see over the last 10 years, dividends increasing over the time period, and not just increasing, we're talking about increasing by well more than 10%, many cases 15%, even one case almost 19%. And overall, for the past 10 years, up more than 260%. So companies that pay dividends, I like to see them growing over time, and for Snap-on, definitely achieving that. And this is definitely a check mark in their favor. And then for shares, I like seeing companies buying them back, and Snap-on, they've been doing this over the last 10 years, reducing their outstanding share count by 9%. And moving forward, we should expect the same, buying back shares every year. So for this is definitely a positive and another check mark. And then revenue and revenue per share. Probably not the two greatest data points we're going to be looking at for Snap-on, as the revenue of the last 2 years is up just over 5%. And on a per share basis, we can see it's up over 6%, 2022 almost 7%. One of the reasons why management said probably not growing as much as they would expect is because their customers are a little wary about the economy. So they're not buying the high-end items. They're focusing more on the low or medium cost items. So kind of impacting their revenue growth there. But they do expect once this situation we're in with the economy starts improving a little bit more, not worrying so much about inflation, we should see this picking up a little bit more. But still, both of these have grown over the past 10 years, revenue up 46%, and on a per share basis, up just over 60%, helped by those buybacks. So for these, I'm going to say these are both check marks. The net income, we can see nice growth over the years, especially over the past 3 years, up almost 31% in 21, 11% in 22, and this most recent year, almost 11%. So far exceeding those revenue growth that we just saw a few minutes ago. And we're going to see in a few minutes, this has a lot to do with their profit margins, which has been going up as well. So though revenue has not been increasing that much, the net income has been increasing a lot more and up almost 140% over the last 10 years. And we're going to give that a check. And same thing, earnings per share, much better growth than what we looked at on the revenue per share basis. And over the last 10 years, EPS is up more than 160%. So another good data point here and another check mark for Snap-On. And then free cash flow and free cash flow per share, we can see a little choppy at times, but up overall over the last 10 years, especially 2023. Nice recovery on the free cash flow, up 78%, and on a per share basis, up 79%. And this overall for the last 10 years for the free cash flow, up almost 230%. The per share basis up 260%. So this company can generate some nice cash, make money, help with those dividend payments and increasing those over time. So both of these are definitely two check marks here. Then book value increasing over time over the last 10 years, no down years. And one quote I always remember from Buffett, when book value increases, the share price will follow. So for this, it's definitely a check mark. Then return on invested capital, I like seeing companies 10% or higher. And we can see Snap-On in that 15% range, give or take 1%. So help by those share buybacks and those dividends. So management knows how to return value to shareholders. So definitely a check mark here. We already touched on net profit margins a few minutes ago. Though revenue is growing around 5-6%, but their net income, earnings per share, are growing over 10%, and it's helped by these net profit margins. You can see here over the last 10 years, definitely growing from 12% to almost 20%, and over the last 4 years, going from about 16% to 20%. So nice growth here, nice improvement on management, and trying to be a little more efficient. So definitely a check mark. Then debt to free cash flow. I like seeing companies under 3, and not only is Snap-On under 3, it's actually been on a decline over the past 10 years. Currently just over 1, so obviously definitely a check mark. So great financial data points overall for Snap-On. Now, the only one thing kind of pointed out a little bit is the revenue and revenue per share. Not growing as much as we would like, but still, they have grown over time. And hopefully when the economy improves a little more, their customers will be a little more willing to buy those higher end ticket items, helping to increase those revenues. So let's move on and look at some valuation ratios. So first valuation ratio we'll look at is the PE, and the red line just shows where it's currently trading at, which is slightly over 14. And we can see it's kind of right in the mix here. About 10 years ago, PE was trading slightly higher, high teens to 20. So we can see it's not currently overvalued. So we're going to give that a positive. And then price to sales, we can see it's been ticking up over the last couple of years, and the highest it's been over the last 10 years at 2.77. Yes, it's higher. It's not extensively higher, but still, it's up there. So I'm going to give this more of a caution or a watch item to look at moving forward. Then enterprise value to free cash flow, definitely on the lower end here at just under 15. You can see historically it's in the higher teens, hovering around 20. So we're going to indicate this as definitely undervalued. And then enterprise value to sales, we can see trending upward, and at the highs it has been over the last 10 years, though not extensively higher, but still it's at the high, 3.08. So I'm going to give this more of a watch item. So these valuation ratios, a little mixed. We have 2 indicating undervalued, while 2 others that are more of a caution or a watch item, indicating it is higher than usual. So something that we'll need to watch moving forward. But let's move on and perform a stock valuation. Here's my valuation for Snap-On, and I'll point out last year in February, I valued the company at $310, and with a 90% margin of safety, brought it down to 280, and that was with a 12% short-term growth rate. Now the stock never got up to 310. The highest it got over the past year was in the high 200s, probably around $297, maybe $298 is the highest it got. So probably that 12% short-term growth rate was a little aggressive. But my current valuation, you can see $300 with a 90% margin of safety brings it down to about $270. And the stock is currently trading around $262. So below my margin of safety. So that's why I bought in recently, both on the 12th and the 13th. And this new valuation is based on a 10% short term growth rate over the next 10 years with a 10% discount rate. And I am using a 3% long term growth rate. Now, up in the top right, we can see the net income CAGR of the last 10 years, slightly higher, just over 10%, while the earnings per share CAGR, we could see 11.3%. So I do think my 10% short-term growth rate, it is in the right range and slightly below what they've been trending for over the past 10 years. But as I mentioned, the stock is currently trading around 262. So let's just see what type of growth rate the market is currently using to value Snap-On. So let's just lower that to, let's just say 8.5%. And we can see it brings the intrinsic value down to $266, and the stock is currently trading slightly below that. So the market's using just above an 8% short term growth rate to value the company. But let's move on into the computer modeling. And first, I'll show you the results from my previous predictions when I did Snap-On about 6 months. And then we will do an updated forecast as well. So here's the previous computer modeling forecast I did back in August for Snap-On, and this shows the three methods used. So the blue is the M5 rule, the green is random forest, and the yellow is the average of the two methods. So I'm going to turn on another layer now. It's going to come up red, and that's the actual stock movement since I performed the computer modeling. And we can see in red the actual stock movements. It's performing the computer modeling back in August, and the stock had a drop off in the price, getting to about $250. And we can see though that Random Forest did project a $250 stock price for Snap-On, but it was later out in January of this year, while it actually happened in looks like around October time period, but recovered, getting up to the average of the two methods and pretty much tracking the average from about November until January. And then we can see the stock has been dropping off probably over the last week or so after they released their 2023 results, as I mentioned, and getting down to that Random Forest stock price. But let's move on and we will update the computer modeling based on the recent results, and we'll see what those projections are showing. Here in the computer modeling software, I already ran the analysis using two methods. First, the M5 rule shown here and random forest. And this data is as of February 12th, this recent Monday. And the far right-hand column is the weekly average stock price for Snap-On. Column right next to it is the S&P 500 ETF weekly average. And other columns are just other various data points used for the analysis. Now, I already copied and pasted all the results and put it into Excel. It's a little easier to see there. But let's scroll down 52 weeks and get a quick look at what the forecast is. And we can see it is showing it higher at $200 and almost $282, just slightly below it. But let's go over to Random Forest and see what that projection is forecasting. So same thing, data is as of February 12th, and scrolling down to 52 weeks, we can actually see it doesn't show much movement in the stocks, actually showing a slight decline. But let's go over to Excel, look at all the data a little closer. Back in Excel, I already pasted all the data from the computer modeling, and first thing I'll point out is the vertical red line represents this previous Monday, February 12th. And everything to the left of that vertical red line is the historical stock price, and everything to the right is the computer modeling projection. Now let's look at a little history of Snap-On stock movement. Going back to 2009, stock price was trading around $30, and from that point it had a nice run up until 2015, reaching $150 and trading above it. And then for the next couple of years, going to 2020, it ranged between 150 and probably 180, $190. But then the pandemic hit and the stock dropped to below $100. But then had a nice recovery, getting to just below 300, but dropping off in February of 2024 after releasing their 2023 results and putting it back to, or pulling it back to where we are today at around $262. But let's jump over to another tab and we will look at the projections a little closer. First, the M5 rule is showing the stock to continue to decline until April, but then it will start to recover, and that recovery will last throughout the year and into February 2025, closing at around $282 for a gain of 7.5%. And then Random Forest is showing a similar stock movement as the M5 rule with an initial dip in the price, but then recovering. However, in 2025, it is projecting another dip in the stock price and closing out the 52 weeks with a slight loss just below $262. Taking the average of the M5 rule and Random Forest, this has the same trend as those two methods. And in February 2025, showing a minor gain, closing at around $272 for a gain of almost 4%. So none of these projections are living up to my stock valuation that we looked at a few minutes ago, but we'll see how the year plays out and where the stock is out in February 2025. To recap, I believe the fair value to buy into Snap-On is between $270 and $300, with the lower end taking into account a margin of safety, while the current stock price is trading around $262. Now, just prior to releasing their full year 2023 results the other week, the stock was trading just below $300, and I believe the market sell-off has been an overreaction, and I'm still optimistic about the company's growth, especially for the long term. And I have added into my investment into Snap-On. For the computer modeling, both the M5 rule and Random Forest have similar trend predictions for the next 52 weeks, though the M5 rule does show a gain of about 7.5%, while Random Forest is predicting a slight loss of less than 1%. Though neither of these predictions reach my stock valuation, I'm still holding on to my position. I hope you enjoyed this video, got some useful information. If so, consider subscribing, and I hope to see you next time. Thanks for watching.